Hello there. Well, there's been a pretty decent recovery in stock markets over the past couple of months after they reached quite a low point in early June. So that's obviously good news for portfolios, which have gone up a bit over that period. But interestingly though, we think actually the economic outlook has actually worsened over that period. As we all know, gas and electricity prices still keep going up, and we see all these horrible predictions for what might happen to the energy price cap in the future. But that price cap only applies to individuals. Businesses don't benefit from that price cap, and therefore the impact on businesses could be even higher if gas and electricity prices keep going up in the way that they have been. We heard anecdotal evidence recently from a chip shop which has just come off a fixed rate energy deal. And obviously, a chip shop uses a lot of energy to keep that deep fryer going all day. We heard from this shop that their previous deal had been about £7,000 a year that they were spending on gas and electricity. The latest deal that they've been offered is more like £80,000 a year, so more than 1,000% increase. And that is actually in line with what's happened in the wholesale market for gas prices. So it actually doesn't come as a surprise. It might be an extreme example. Maybe other businesses might have a smaller impact, but still it could be quite significant. So we think the government is going to have to do something to not just support individuals and households, but support businesses too. There is almost no doubt about it, because if they don't, we think we will go into really quite a steep recession, and that's obviously quite worrying. So from an investment point of view, we think the outlook's worsened, but the market's got higher. And interestingly enough, when a few months ago we were saying that we thought actually the market was pricing too high a level of inflation, and that they were pricing too much in the way of interest rate hikes, market pricing for both those things has changed. And now the market pricing for interest rate hikes is a bit lower than it was a few months ago, same with inflation. And we think that doesn't make a lot of sense to us. That markets have gone up, interest rate expectations have gone down, inflation expectations has gone down, but that doesn't chime with what we're seeing in the real world. So I still think inflation will come down next year. It's just mathematically, because of the way it works, it's very likely to happen, but I think it will peak higher than we had previously thought, and it could be more persistent for longer. So as a result, we made a few changes to the portfolio just to try and reduce risk after that bit of a recent rally. So within equities, we've actually reduced exposure to UK stocks, which we think the UK and Europe are more vulnerable than other parts of the world. And we've increased exposure to what we would call global quality stocks, those companies where we think the earnings will be much more resilient if we do go into a downturn. We've also, because bond yields came back down as interest rate expectations came back down, we also decided to take some money out of fixed interest, out of bonds, and put some into more alternative or absolute return type strategies. So just feeling a bit more cautious about things at the moment. If we did get another pullback in the markets, then we think it would be a good opportunity to top up again. Still think equities will provide some really good long-term returns, but could we have some more volatility and some more another pullback? Absolutely, we think that's certainly possible. So just trying to position some of the portfolios in a little bit more of a cautious way. So I hope I've not painted too depressing a picture for today. I still think, as I say, long-term equity returns would be good, but we just need to be a little bit more cautious given the outlook that we can all see out there at the moment. So thanks very much. See you again next month.